Hi, I'm John Henderson, author of Retail and Digital Banking. This is often the belief, but more often than not, changes in regulation only address the past and does not prevent future problems from happening. New regulation typically emerges on the back of a major financial failure, such as the banking crisis of 2008, but seldom does new regulation arise during the upturn in the economy. Concern about rocking the boat or destabilising the return of the good times typically affects the desire to regulate. As part of the European directive, the UK introduced deposit insurance in 1979 up to £2,000 fully insured and up to £35,000 90% protected, which remained in place right up until the financial crisis. Only then was the upper level of deposit insurance increased to £50,000. And this is a classic example where, with all good intentions to protect customers, both the banks and indeed customers can take advantage of a scheme such as deposit insurance and create what is known as a moral hazard. So first of all, from the customer's perspective, they can spread their wealth across financial institutions that offer the best rates of interest, and then they're safe in the knowledge that their money will be repaid should that financial institution fail. Similarly, banks can be affected by moral hazard and may act irrationally with customer deposits and take a riskier approach when lending their deposits for a higher return, safe in the knowledge that should the worst happen, then their customer deposits would be repaid. Whilst deposit insurance was intended to give customer surety about the safety and security of their deposits, this in itself is not the reason why bank runs will continue to happen to banks, as the issue is gaining immediate access to customer deposits. No level of deposit protection will stop customers clamouring to get their hands on their money.